A lot of people would instantly hear that and go, "Oh, that system's no good. 60% losers," and they instantly dismiss it because they don't understand. This is why trading and investing is just so unintuitive to most people. So most people would look at a win rate and think that unless there's a high success rate, it mustn't be very good. Because like if you're a doctor or you're an accountant or you're a pilot, it's all about high success rates. Like no one's going to get in a plane with a pilot who has a 40% success rate at landing. It's just madness. So that's how we're wired to think. But then you come to this trading and investing world, and all of a sudden people are telling you, "Oh, look, it's okay to only be right 40% of the time." And it's like what? And George Soros, the famous hedge fund guy, he once said that it doesn't matter whether I'm right or wrong. All that matters is how much I make when I'm right versus how much I lose when I'm wrong. And that's it. That's what it's all about. You've got to understand this. Unless you understand that, you're going in with the wrong mindset, and you're probably destined to hit the rocks, because you're going to be thinking, well, none of this is working, but actually might be, but you don't understand the process. But once you've got an algorithm there and you're calculated levels, well, everything becomes quite clear cut. As long as you can follow a set of rules and a set of signals, well, it really does strip the emotion out of it.
Welcome to the Get Invested podcast, where we share great conversations with experts from all walks of life to uncover their secret know-how and where they invest their time, their skills and their money, and the benefits that this has created. You see, the truth is that everyone invests. Every minute of every day, we're investing our time, our skills, our energy and our money in something. Some of us are investing consciously, some unconsciously, sometimes for good, sometimes for bad, sometimes for no impact. Get Invested will help you to start living by design, not by default. I'm going to help you to make it happen, not let it happen. You will hear the top tips on how you can live with conscious intent so that you can live more, work less, and leave a living legacy by investing now. Listen to the show to discover the top tips on how to get started, make the most of your investment journey, and ultimately to be living your dream, not someone else's. More episodes can be found on iTunes or at bushymartin.com.au/get invested. Thanks for listening, and now let's get invested.
Hi, freedom fighters. What are your success systems? What happy habits, daily disciplines, or rewarding rituals do you follow? And on a related topic, if I came to you with an investment opportunity that lost money 60% of the time, would you go for it? An opportunity that failed 6 out of every 10 times. Would you be prepared to put your hard-earned savings and income at risk? My bet is that your answer would be no. Yet these are exactly the sorts of odds that the select few successful investors embrace and make very good money on. Now, I know what you're thinking. How could that possibly be the case? This is sounding like total BS, Bushy. I'm thinking you're losing the plot. Well, believe me when I say that you can still invest very safely and profitably while only making money 2 out of every 5 times. And I know this because I've adopted this approach myself in the past. And today's guest is going to talk about how you can do it. And he shares so much gold with us that we're splitting our conversation over both today's and next week's episodes. And the secrets to the success of this approach are very simple and straightforward to understand, but much more difficult to implement. And the reasons are not due to any complexity or special skill required, but the major obstacle revolves around ourselves. We are our own major obstacle. But I'll come back to this later. Because now I want to return to the related question that continues to plague me. Why don't more of us achieve or follow through on our big goals? Why don't we take the actions today that we all know are going to benefit us big time in the long-term future? Why don't we display the patience, the persistence and the resilience to see these things through? I continue to search for answers on this subject as I believe it's the growing malady of our time. And it's going to affect our futures and the world we leave our kids and our future generations. How do we break the cycle of self-centered short-termism and reap the rewards of long-term indefinite outlooks? How do we switch from short-term success to long-term significance? Because my biggest fear is that we won't survive our own pursuit of instant success. So this week, I want to start by turning to the wisdom and the insights of James Clear for some more answers and options. In his book Atomic Habits, he starts with a story about Team Sky, which is Great Britain's national cycling team. In the late 2000s, they hired a new general manager, Dave Brailsford, and at the time, Team Sky had a very average record when it came to performance on the world cycling stage. They'd only won one gold medal in the last 100 years from 1908 through to 2008. They'd never won a Tour de France, which is the premier international event in cycling. So when they hired Dave Brailsford, they said, "We want to improve our performance and reach a much higher level of achievement. So what's your plan to help us do that?" And Brailsford responded, he had a strategy and a system called the aggregation of marginal gains. And the way he described it is that it's a 1% improvement approach in nearly everything that you do. So they started by looking at all the normal things that a cycling team would look at. They improved their bike tyres by making them slightly lighter. They put a more ergonomic seat on their bikes. They had the riders wear biofeedback sensors so they could see how each person responded to the training and practice that they were doing every day. And their outdoor riders wore indoor racing suits because they're lighter and more aerodynamic. But they did a bunch of things that you wouldn't expect a cycling team to do. They split tested different types of massage gels to see which one led to the best form of recovery. They got their riders to wash their hands regularly in antiseptic to reduce the risk of infection. And they even tested which type of pillow led to the best night's sleep for each rider, and then brought them on the road with them to the hotels that they were staying at while they were travelling. So Brailsford said that if we can actually execute and commit fully to this strategy, we can then aggregate all of these small changes and improvements, these 1%ers, with an aim to win the Tour de France in 5 years. He ended up being wrong. They actually managed to win the Tour de France in just 3 years. And then they repeated the victory the year after with a different rider and went on to win 3 years out of 4. And Brailsford's strategy really paid dividends at the Olympics in London in 2012 when they won 70% of the gold medals. And the conclusion that we draw from this is that continuous small improvements that revolve around a comprehensive system can all add up to very significant changes over time. And if we do the basic maths by getting 1% better every day for 365 days, you actually end up 37 times better at the end of the year. Conversely, if you get 1% worse each day, over the course of a year, you take yourself almost down to zero. Now, I can hear you say that 1% improvements would be great, but clearly no one's going to get 1% better every single day. So is it really realistic to ever really accumulate into anything if we're not going to be perfect every time? Well, as James Clear argues, yes. You can still be 10 times better at the end of the year if you just get 1% better 5 days of a week for 46 weeks a year, allowing 6 weeks off for holidays and illness, etc. And the way to do this is not by setting bigger and better goals for ourselves and others, but by building better systems and creating better habits. In the case of Team Sky, their goal never changed. They always wanted to win gold medals. It wasn't the goal that made a difference. It was their system, their comprehensive system that was applied day after day to achieve those continuous 1% improvements day in, day out. And it wasn't only what they did that mattered, but how they also changed their thoughts and beliefs about themselves and what they could achieve. This made all the difference. Because there's a deeper level of behaviour change at play that evolves from new system and habit formation. The normal outer layer of behaviour change is focused on the results that we get, on the outcome and the goal. This is the external outside layer. Often, we say we need better goals, we need better outcomes, we need better results. So to do that, we take one step in on behaviour change and we talk about our actions. Now, the results and the actions are usually where we stop when it comes to creating habits, systems, and behaviour change. How can we build better habits? How can we take more action on this particular goal? How can we take an action to get a desired result? But James Clear argues that there's even a deeper level of behaviour change as well. And that level is mindset or belief or identity. Because the identity that we hold drives the action that we take and the results that we get. So deep and lasting improvement comes down to the integration of RAM. Yes, another one of the bushy acronyms. Results, actions, and mindset. And it all starts with our mindset. Let's look at a common example when it comes to weight loss. So losing 10 kilos over the next 6 months is the outer results layer. In order to lose those 10 kilos, you need to move into the actions you need to take, like eating healthy and reducing your food intake, so say let's 1,500 calories a day, and walking half an hour a day. And most people stop there. So in this case, the missing identity might be that you want to become the type of person who eats healthy and doesn't miss your daily brisk walk. So the argument becomes that if you focus on the identity and you work at becoming the type of person who doesn't miss walks and eats well, and only focus on the core behaviour change, these developing habit systems will ripple out to the outer layers anyway. So the key idea here is that a shift in mindset leads to a shift in daily choices. And a shift in daily choices leads to significantly better results in the long term. And to support the development of a rewarding ritual system, Clear believes that you need to incorporate what he calls the 3 R's of habit formation: reminder, routine, and reward. The first reminder step is the prompt, the cue, or the trigger that starts the habit, like a traffic light turning green to go, or your phone buzzing. The reminder signal or trigger that we need to be doing something. The follow-on piece then is the routine, the behaviour itself, the actual habit that you're looking to form, like driving through the intersection, or your phone buzzes as the trigger and you answer the phone, which is the routine. The third piece is the reward, the benefit that you get from doing the behaviour. And it's important to note that all habits, both good and bad, have some kind of benefit or reward associated with them. In the driving example, you move closer to your destination. But let's take smoking as another example. Smoking is seen as a bad habit, so what's the reward? Well, there's a physiological reward, but also the social reward of sharing a dairy with a friend or a colleague. So regardless of how we label habits or repeated behaviours, it's important to note that all of them have some kind of benefit that's neurologically associated with them. So your phone rings as a reminder, you answer the phone, that's the routine, and you get to satisfy your curiosity or find out who's calling. That's the reward benefit. And what ends up happening, if that reward is positive, then it tells your brain, hey, next time this reminder happens, next time this trigger comes along, you'll repeat that pattern, and if you make it through this cycle enough times, it becomes a habit and an ingrained closed behaviour system is created. So how can you leverage the first part of the trigger reminder to make positive changes? Let's say you wanted to start meditating. And the first thing you normally do in the morning is to make yourself a cup of tea or coffee. So to create your new meditation behaviour, you could say, when I make my morning cup of tea or coffee, I'll meditate for 60 seconds. And so the current behaviour, the things that you're already doing, become the trigger for the new behaviour that you're trying to create. And the reason that this is so important is that your current behaviours, the things that are already your habits, have this neurological network built into your mind that creates an on-ramp on your brain so that you're just tapping into that and then tagging the new behaviour and linking it to something that's already strongly correlated in your mind. And then you can apply the 2-minute rule. Now, there's no habit or system that you're going to develop that's going to take less than 2 minutes to do. However, any habit can be started in under 2 minutes. If you're looking to start a daily exercise routine when you finish work, you probably normally say, I'm just too exhausted to go for a run or to try to exercise. So you never get around to it because you mentally think, I have to run 5 kilometres or a really long distance, and that just seems way too overwhelming. Or if you want to learn something about investment, you might have big intentions of reading a book at night, but by the time your head hits the pillow, you're just way too tired. Or in my case, I'm currently wanting to learn a really difficult new piece on the piano, and I'm a little bit daunted by the length and the complexity of the composition. So rather than focus on the entire thing that you need to do, just focus on doing the first 2 minutes. So what's the first 2 minutes of that habit? In the case of the jog, you put your running shoes on, you go out the front door, and you lock it. With the investment book, you just read 1 page. And with the new piano piece, instead of trying to learn and memorise the 2,000 notes in one hit, I just learn 1 note and 1 bar at a time and just keep adding to it incrementally every day. And if you just do that, it doesn't matter if you take another step or read another page or play another note. But what you find is that motivation often comes after starting, not before. We often kid ourselves that motivation is something we're supposed to have before, but motivation will come as a result of doing some small piece of work, and then we can trust the rest of the process is going to flow smoothly and easily. So just start in some very small way because it's the start that stops most people. The point here is that the motivation needed is at its peak at the beginning of the new behaviour, and the greatest amount of friction for any task is also in the beginning and in the starting. So the key is to make it so easy that you can't say no. Another tip to get started is to use public pre-commitment, which is like an instant willpower improvement. If you're going to start a regular exercise program, research has shown that if you simply write down and publicly pre-commit, like posting on Facebook, that during the next week, I'll do at least 20 minutes of vigorous exercises on this day, at this time, at this place, then you're 4 times more likely to follow through. So habits are the compound interest of self-improvement. Just as compound interest accrues exponentially over time, so your habits multiply over time. So often, the 1% of choices that you make either for you or against you each day are easy to overlook on a daily basis. For example, what's really the difference between eating a burger with fries versus a green salad for lunch? The burger may taste better in the moment, but you're likely to gain weight over the long term, while the green salad may taste quite bland right now, but you're likely to be healthier and lose weight long term. And the challenge is that habits are immediately satisfying and are more likely to be repeated. Pretty much any behaviour can produce multiple outcomes. For instance, if you eat a donut right now, it's tasty and sweet and sugary right here, right now, but in the long run, you're going to gain weight. So, like many bad habits, the immediate outcome is favourable, but the long-term outcome is unfavourable. With good habits, it's often the reverse. If you go to the gym right now, it takes a lot of effort, you sweat, and you have to work hard. So the immediate outcome may be unfavourable, but the ultimate outcome, being in shape in a year or 2, is favourable. And so the challenge for creating good habits and breaking bad ones is often trying to find a way to pull the long-term consequences of your bad habits into the immediate moment. So you feel a little pain right now and want to avoid it. And you need to pull the long-term consequences of the long-term rewards of your good habits into the immediate moment so you've got a reason to repeat it in the future. Now, one way to do this is to introduce a system of immediate pleasures for any good behaviour habit that you're trying to encourage that leads to achieving your long-term goals, or pains for any bad behaviour habit that you're trying to change. So let's say that you're trying to fast until lunchtime every day to lose weight. For every day that you do this, you reward yourself by allowing yourself to watch an episode of your favourite series on Netflix that night. If you don't achieve it, you suffer the pain of not watching the Netflix show, and instead you do an extra hour of housework that night. Now, if you manage to fast until lunchtime for the week, you get to go to the movies. So introducing an immediate reward system for repetitive actions that create long-term gains is pulling the long-term consequences of your developing good habits into the immediate moment as an enticement to keep repeating it. You can do the same with saving money or investing regularly. Reward yourself regularly with things you like for actions that create good habits that will achieve your long-term goals. Now, each time you do a behaviour, you're actually casting a vote for the sort of person that you want to become. And if you cast enough votes for that identity, you start to believe that about yourself. If you go to church for 20 years, you believe you're religious. If you're like me and you play field hockey for 49 years, you believe you're a hockey player. So in this way, your habits provide evidence of your desired identity, of the future self you want to become. And this is the ultimate reason that habits are so important. Sure, good habits can help you build more wealth, earn more money, and be more productive, to increase your skill and expertise, and this is great. But in addition to the external results that good habits provide, they also shape your internal self. They're the engine and the avenue through which you learn to believe things about yourself, to build your sense of self-worth. The power of doing better habits each day and week and casting a repeated series of small votes for the type of person you want to become is that now you're accumulating healthy habits that are creating a body of evidence to base your beliefs on. The more you show up as who you want to be, the more you believe it, the more self-confidence you have, and the more you're likely to keep doing it. This is my concept of self-reinforcing growth through the cycle of self, health, and wealth habits in action. Developing good daily disciplines, healthy habits, and rewarding rituals improves your health, improves your wealth, which also improves yourself. And the more self-belief and self-worth you develop, the more your self-confidence grows, the more your health and your wealth improve. So achievement in all areas of your life revolves around the power of developing a system of healthy habits, a system of tried and proven rewarding rules that create an invisible hand that quietly guides your life. And the more this system of behaviour becomes automatic, so that you don't have to think about it, and your personal subjective thoughts, tendencies, biases and judgments are removed or eliminated, the more likely you are to stick at it and the less likely you are to self-sabotage. Because this brings us back to our opening discussion about what's the biggest inhibitor to our progress in any area of our lives. It's ourselves. It's the person staring back at you in the mirror. Our inbuilt human nature, our fears, desires, and our reactive emotions get in the way of rational logic at the most crucial times. And this brings us back to where today's guest can help you with your long-term investing. In recent times, I've noticed a lot of people jumping on the bandwagon of the stock market on a whim and a prayer. And when a taxi driver and a coffee baristas are talking to you about the money they're going to make in the stock market, because shares must be cheap after the recent fall, then you know we're in trouble. And with automated everything, it's easier than ever to get in and easier than ever to do your dough very quickly. Or worse still, start buying shares purely on the strength of a backyard tipple because you just like the company, and then just hold on to them without any idea or plan on when you'll get out, which generally means you end up selling them prematurely and not allowing your profits to run, or worse still, holding on to them when they've gone down in value on the unfounded hope that one day they're going to come good. So this is where today's guest Jason McIntosh comes to your rescue. Jason is the creator of Motion Trader, an online advisory service for retail investors and self-managed super funds. His career began way back in 1991 on the trading floor at Bankers Trust, where he got to work with some of the best investment traders in the world. And he gave up the hustle and bustle of the CBD back in 2007. Nowadays, he manages his family investments from his home in Sydney because, like me, at the end of the day, investment is all about lifestyle. And what Jason enjoys most is teaching everyday hardworking Aussies to invest like the pros. He loves helping struggling investors to become much more profitable. And if you're ready, he'd love to help you do the same. In technical terms, Jason is a share market algorithm investor. He's developed a proven, profitable and robust share investing system that's personally returned his investment portfolio over 10 to 12% per annum, as you'll hear during our discussion. Jason's Motion Trader is a medium-term trend-following strategy. The aim is to use proven algorithms to identify stocks which meet the entry criteria. It's then a case of letting profitable investments run and cutting losing ones relatively early. Winning trades often last for around a year and some last several years, whereas losing trades typically last only a few months and some even exit within days. And the good news is that he now helps you remove yourself and your self-sabotaging ways from your investing through his investing service, incorporating all of the good habit-forming system principles that we've already talked about today. Jason doesn't talk about success rates. He talks about the probability and the profitability of your trading system. Systems where you can have more losers than winners and still end up making money. How? Because your many losses are small compared to the much bigger size of your few wins. It's how I had 60% losing trades but was still profitable. It all relies on a good investing system that relies on a proven set of predetermined rules for entering and exiting share purchases that follows trend patterns. And Jason has taken this to the extreme by using sophisticated algorithms to do all of the hard work of backtesting, which is a fancy word for proving up rules based on years of historic performance. So he's backtested every share on the stock market to identify reliable buy and sell signals. And the beauty of Jason's Motion Trader approach is that his algorithms do all of the homework and the research for you. And because the work is technically based, the trading rules remove our subjective emotional judgment and reactivity, which is the cause of most investment underperformance. The other beauty of Motion Trader's service is that it's a medium-term technical investment system, which only needs a very small amount of your time to manage and monitor the trades that run for up to 1 to 2 years. And for most time-poor professionals, the personal time required to manage your investments is really important, because I've seen many investors who get way too busy to monitor their short-term investment approaches and they lose money and opportunity as a result. So no more laborious poring over the financials and company performance fundamentals, because in my humble, unqualified opinion in our electronic trading age, share prices are less related to company performance and more related to perception-driven, electronically triggered sentiment. So reading the trends are your real friends, and Jason helps you uncover them. I've always said that investment's all about the numbers, and I don't even want to see the property, and I don't need to know anything about the company that I'm buying shares in. In fact, I prefer not to, because I then start getting emotionally attached, which can then result in poor judgment and bad decisions. And in line with this thinking, Motion Trader's algorithm analysis, along with his email potential trade notification service, means you don't need to do the homework. You just need to follow these signals. In simple terms, Jason and Motion Trader uses a proven system that helps you develop good investing habits that will be the foundation of your long-term wealth creation success. Jason says that people often say that successful trading is all about secrets. They believe the best traders have some special knowledge that regular people just can't access. But you know what? In Jason's opinion, there are no secrets. The strategies the best traders use are nothing new. They're mostly variations of the same winning tactics that have been in use for decades, if not centuries. Many traders make the mistake of focusing on just one thing, when to buy. And yes, entries are important, but they're just one cog in the machine. The difference between success and failure are actually the rest of the cogs, although many people lose money long before they even figure this out. So, how do some of the best traders make millions? Well, in Jason's opinion, it essentially comes down to just 5 key rules. Number 1, trade with a trend. Secondly, have many relatively small trades. 3, get good at quitting. 4, be slow to take profits. And 5, give winners room to move. Now, if you're interested in learning more about the details of these secrets, Jason and Motion Trader have kindly given you free access to his exclusive report called 5 Secrets of the World's Best Traders. So if you'd like an electronic copy, just email me at bushy@khgroup.com.au and we'll get it to you. And if you're interested in Motion Trader assisting you to invest in the Australian stock market much more successfully after listening to Jason's engaging conversation, just jump on www.motiontrader.com.au/learn-to-trade-shares for his free online event on how to build a profitable share portfolio now. And just mention my name, Bushy, when you register to make sure that Jason looks after you. In the meantime, enjoy the first part of our great conversation on how you can invest in the share market safely, affordably and profitably through algorithm technical trend trading with Jason McIntosh. Welcome back, Freedom Fighters. Now, there's been a lot of talk about equities markets in recent months since the shock of COVID, and it almost seems like every man, woman and child and his drover's dog all of a sudden wants to get in the action, and we're hearing about Robinhood zero-fee platforms and robo-trading making it easy to jump in almost on a whim. But is this a smart way to invest? I question that. So to help you better invest and to trade successfully, I thought it was very timely to talk to a successful and specialist algorithm investor, Jason McIntosh, to give you his take on how it needs to happen. So welcome, and let's get invested, Jason.
Bushy, thanks for having me on the show. I've been really looking forward to coming on and having a good discussion and talking with your listeners. So, yeah, thank you.
Yeah, my pleasure, mate, and likewise. I've sort of had a chance to do a fair bit of Google stalking now, mate, and the more I look, the more I like what I see and hear, mate. So I think we're going to have a great discussion.
Oh, that's good.
Great value to the listeners on really starting to look at equities investment in a different light after we've gone through it today. But, mate, for those who don't know you, can you sort of give us a rundown on who you are, what you do, and why you do what you do?
Yeah, well, look, I guess the short answer is that I help people make sense of the stock market. And by that, I don't mean I just tell them what to buy and what to sell, but I also explain the process. So it's really about giving people the skills to confidently trade and invest in the stock market themselves. You know, Bushy, people often make it all sound really complicated when they talk about the stock market, but like, while it's not necessarily easy to make money, the process itself, the process is actually really straightforward. And that's what I'm helping people understand. And I'm also giving them a complete process. So it's not just about like how to find the next superstar stock. It's also about like how much do you invest in each stock. And it's about when you should buy and deciding when you should sell and deciding like how much you should risk in each particular investment. And look, it's just so interesting because like in the course of like what I do, I hear from people who have been investing in stocks for years but without success. So yeah, it could be like 10, 20, 30 years in some cases. And it often turns out that they're just missing maybe one or two pieces of the puzzle. And those pieces, they usually have something to do with selling. So either they're holding their bad investments too long, or perhaps they're selling the good ones too early. And in some cases, it's a matter of they sell their good investments way too late, and they give back big profits in the process. And look, so that's what I do, and it's something I enjoy. It's a good business doing that, but it's also that whole act of explaining to people like how things work and how they could use these processes better for themselves. Like I really enjoy that. I think I'm actually a bit of a teacher at heart, and it's like mentoring people has been something I've always really enjoyed doing. So whether it be mentoring the junior traders on the trading desk when I was back at Bankers Trust in the 1990s, or mentoring school kids, and I actually did that over the last few years. There's my old high school. They do this thing called a Business Week program, and they get the year 10s, and they compete in an online business simulation over the course of a week. And so the kids get put into groups of, I think it was about 12.
Yeah.
And what happens is they ask the parents and the old boys, which I'm one of, to go up and be mentors. So I thought, yeah, look, this sounds good. I'll do this, and I did it for 5 years,
Wow.
and I really liked it. Really liked being up at the school, hanging out in the staff room with the teachers, mixing with the kids and helping them understand business. It was really good. So that's I liked it so much. I actually went off and got a teaching degree. I had this brainwave. I thought, okay, so this stuff, talking about business with the kids is fun. So if I go off and get my Bachelor of Education, which tacks on to my economics degree back from when I was left school.
Yeah.
I thought, well, okay, I'll be able to then teach business studies, commerce and economics, and then trade and invest in the markets as well. And I'll tell you, I was completely deluded, because teaching has to be the hardest job on the planet to do, or at least one of them, to do really well. And the teachers who were really good at it, they just loved what they did. And I was there halfway through the degree thinking, I can't do this. This is just too hard. It's trading stocks is easier. It takes me less time, and I need to I'm not up at midnight analysing a stock, but I'm up at midnight preparing lesson plans. So I thought I'll leave teaching for the teachers who are really good at it and love it. And but I'll tell you, it's a job that deserves a lot more respect than it gets.
But
those skills I've put to work still in what I do with helping people in the stock market.
Yeah.
And but people get sceptical. They think that anyone who tries to tell them something about the stock market, they mustn't be very good themselves. They think that, like, this is a comment which I get every year without fail for years. Someone will say, if you're so good at what you do, why are you telling us? Why aren't you keeping it a secret and doing it yourself? And it's funny. People have told me that Facebook, they said, look, you got to get on Facebook with your business and start marketing it, because you can target the groups of people and so on. So I thought, look, I'm not much of a Facebook user, but I'll give it a go. And so I put up this video, and it wasn't even an ad. It was an information piece. It told this this fantastic story about this group of traders in the 1980s who went on and made $175 million just through following a process.
Wow.
I won't tell a story within a story, get way too confusing. Save that for another day.
You're not Billy Connolly then.
But, yes, I put this up, and do you know what happened? The trolls started coming out from under the bridge. And this one guy in particular, he came at me a few times. He said, Facebook is full of scams which separate people from their money, and I wish you guys would all just bugger off, in more colourful terms than that. And I just thought, look, this is what people think. People think that if you're offering advice in the stock market, it must be because it's not that good, because you're not using it themselves. And I think that's probably true in some cases, maybe a lot of cases, but there's also a lot of people out there who are actually quite good at what they do, and they're worth listening to. Because when I started out as a junior trader, as a graduate at Bankers Trust in 1991, I probably went in with those same sort of ideas around, good traders trade and bad traders teach. But it turns out that the best traders at Bankers Trust, and this was the place where all the best traders in Australia pretty much were, the best traders were the most generous with their time. And look, I think that's what we do as humans. We pass stories down the line, and that's why I do this. It's like I'm passing the stories that my mentors told me and their mentors told them, and I'm telling the subscribers of my service and people who tune into my videos and want to hear what I have to say. So that's why I do what I do.
That's a really good description there, mate. And I 100% agree with you. I often get the same thing. Well, Bushy, if you're so good on the property front, why aren't you kicking back drinking margaritas on the beach? If you're trying to flog it to us, then there must be something wrong. And they're missing the point, which you've sort of stated yourself, the fulfillment you get from helping others to see the light and see them to change their life, you just can't put a price on. I even find it hard to put into words, Jason, the sense of fulfillment I get from actually and satisfaction from seeing people really make some massive changes and improvements in their life. And what you're doing from the trading perspective has exactly the same impact. So
I know what you mean. I know what you mean. It makes my day when I get an email from someone someone who's been with me for a while who says, I've done all the wrong things for years and now I'm making money. I'm wrapped. It really does put a smile on my face.
Yeah, it
and
does.
Look, I decided long ago that there were so many markets and so many opportunities, I couldn't trade them all anyway. So it just made sense to build a business that helped provide those ideas to other people. Going back to my teaching and my mentoring side, but then also developing a profitable business, which is all about I trade stocks, I do property, I've got a business, I've got different income streams. So it all meshes together really nicely.
Yeah,
and the skeptics, they're just they're barking up the wrong tree, they're just missing the point, which is a shame. It's like one of the things I always tell my kids is you've got to be open-minded. If you approach things with my glass is full, I can't take any more in, it doesn't work and you miss out. So be open-minded and be prepared to investigate things. Some people are probably you should be duly skeptical about, but unless you investigate further and form some actually informed opinions rather than just shooting from the hip, you'll never know.
I totally agree, and I think healthy skepticism is actually a very good place to start, because it means that you're then going to ask all of the hard questions to give you the information that you then can make an informed decision against. But trolls it's very easy to be a strong troll on Facebook because you never get to see them, you don't know them. And I'm a firm believer in what you put out is what you get back. So if you're going to criticise everything and do nothing, then it's no surprise that your position in life might be where it is because of that. But I won't get on the bandstand here, mate. I'd love to delve into now is to get you to take us through your journey from as far back as you'd like to go, and sort of walk us through what you've invested your time, your energy, your money in, what worked, what didn't, what did you learn along the way, and how and why has it got to where you are and what you're doing now?
Yeah, well, it's funny when you look back and you join the dots. And so my first exposure to risk was when I was around, like financial risk, was when I was around 10 or 11, and it was through the horse racing industry. You see, Dad had a couple of racehorses, and so because Dad was involved, so I'd go out to the track with him, and it's like I loved it. I loved the colour, the excitement. Watching the bookies and changing the odds. So I started to understand odds, and Dad would give me $10 to put a few $2 each way bets sort of thing on. So understanding that if you put your money on the favourite, you don't win so much if you're right, but if you can find a good outsider or just a middle lot horse, 6, 7, 8, 9, 10 to 1, you could get some quite good returns. So that sort of got me thinking about turning money into more money. Wrong way to go about it, but it was nonetheless a start. And funny thing was, I actually my first career choice, it was probably my second career choice. First career choice, I wanted to be a pilot. Second on the list, I decided I wanted to be a jockey. Now, unfortunately, I can tell you, I'm 6'1" and I weigh a touch over 70 kilos. So it wasn't going to work.
You'd have to cut off both legs, I reckon, mate, to have any chance.
But much to Mum's horror, I decided as an 11-year-old I better start dieting because I had to keep my weight down. And I think that madness only lasted for maybe a week or two. But it's funny when you think back at some of the stuff that goes on. So a jockey, that didn't last long. I get into high school and I thought much along your own lines, an architect. Or I still had the idea of aviation, and middle high school, because things are always evolving, aren't they? You know, you rarely go down one line and don't deviate. So by middle high school, I'd started thinking, okay, maybe it's stockbroking. That started to become on my radar, because you see, Dad was...
mate? Yeah, I'm interested in at such a young age, because it's pretty rare, middle high school, to start thinking I want to be a stockbroker. What sowed that seed, and where did that interest come from?
It was Dad again. So he got me into the racing, and now he's got me into the market. So it's an interesting development as a youngster. And so he was involved in some of the speculative miners over in WA back in the mid '80s, and I remember this one stock. It was probably the first stock that I bought. Bought it with Dad, so they're probably all in his name. But it was this company called Transcontinental Mining. It was either gold or oil. I think it was oil, and they're always drilling. And so, you know, that's back in the days where, you know, you get the paper in the morning and the afternoon and get the share prices. And, I thought that was all very exciting. And then would be waiting for the broker to call with news of the latest drilling results. And, you know, they drilled and drilled and drilled. They never really seemed to find very much. And, you know, the share price would spike up on the hope that the drilling would find this new, you know, reserve of oil. Then it would collapse again when nothing was found. And, I loved it. I thought it was exciting, and I loved the prospect of a big win. And they're two of the worst possible reasons to enter the stock market. But nonetheless, that is what got my attention. So, yeah, it doesn't always matter what got your attention, just as long as it got it, perhaps. So,
yeah.
You know, I found a better way later on, but that got me interest. So from there, it was off to the uni to do economics, and this is where I had a stroke of luck. And I was in my last year of uni, and I had a mate who had I think he must have had a holiday job, a Christmas holiday job at Bankers Trust. And they offered him, they said, look, we need someone to come in after uni, Monday to Friday, to work on the bond desk in the dealing room. They're just compiling the daily rate sheet and sending some faxes to the London office, that sort of thing.
Yep.
And my mate said, look, I'd love to, but the uni I'm going to is 40 minutes from the city, so it's a bit hard for me. But I've got a mate who might be interested, and I just happened to be the mate. I was at Sydney Uni, and that was just 2 stops from the CBD on the train. And so went in and had the interview. That went well, and they said, like, yep, look, come in. Would like you to do this, and this is a great thing. This is the tip to all any youngster. It's just get your foot in the door. It's getting in there made the world a difference, because I was able to look. I did what I was doing well, and I came up with some new ideas to do things better, and I must have impressed them a bit, because then after towards the end of the year, I went up to the head of the dealing room and said, hey, look, I'd really like if you guys could consider me for a graduate role next year. And these were hard to get.
Yeah.
And he said, look, look, you've been doing well. I'll ask around. And he came back the next day and he said, look, 2 heads of department want to talk to you, the head of the futures floor and the head of the charting department. And, as a young guy, I'm 21, I instantly thought, futures floor, exciting. So we go back to this excitement sort of phase I'm still in. Exciting, they're waving their arms, they're yelling out. It looks like craziness. Lots of fun, and charting, a bit boring. But again, luck steps in, and luck goes. The head of the charting department was the first to speak to me, and he said, "Look, okay, I'll offer you a job." So I wasn't about to say, "Oh, look, let me think about it. I'll get back to you." It was like, "Okay, done. I'm in. I'm there. What time do you want me to start?" And that's fate. This is just complete fate, really, because when I look back, the futures floor, I wouldn't have lasted. It's not set up around the way I operate, so I wouldn't have been successful there.
Yeah, let's jump in there, because this will be interesting for some of the listeners who are just starting to perhaps consider what they should be doing, and if they are going to invest in the markets, and if so, what they're going to do. And I know it's a very different scene now to what it was back then, but talk to us about the psyche that would work well in the futures area versus a psyche that would work best in charting, and where your approach and your style was best suited to charting.
The futures floor, the guys on the futures floor were filling orders for the guys in the dealing room who were taking the positions. So the futures floor traders weren't the position takers, they were the order fillers.
Yeah.
And it's very quick, very fast. You have to be extremely nimble with numbers in your head, and it's not a thinking job. It's a very fast reacting job. Look, they're thinking about stuff as well, but it's not you sit down and consider something. It's like futures. It's when the market's moving, it's just bedlam down there.
Yeah.
Well, it was. That's the old open cry. That's all gone now. It's all now on computer screens. So it's different. It's a different world.
Yeah.
And what I discovered about myself was I was more thoughtful in my approach, in that I wanted to sit down and it's more like playing a game of chess for me.
Yeah.
I want to think about the next move and then a couple of moves after that, possibilities. That's just my style. Some people like Fast and Furious, but it wasn't for me.
But there's a real key right there, I think, in terms of adopting what you're going to invest in and how you're going to invest to suit your style. Because a lot of people, as you've mentioned a couple of times already, are enticed by the excitement, which, as we both know, is the worst possible reason to do something, because good trading is like watching paint dry. But
it is, yeah.
Having the sense to go, right, well, this is going to suit me in the way I think and way I act, and therefore more likely to do better is the first thing, rather than chasing the perceived excitement or the perceived big wins that you're likely to get out of something.
Yeah, you've got to decide why you're doing something. So before you decide, okay, I'm going to trade and invest in stocks, like, why am I doing that? Am I doing it because I want it as a growth asset or an income source, because that'll affect what you invest in, and or you're doing it because you like the intellectual challenge of like finding ideas and testing them and turning them into a systemized process, or do you or you're doing it because it's just exciting. It's like things are moving and it's all very quick, and you buy something, then you sell something, and it's go. That's sort of really the wrong reason. That's sort of like a day at the races. It's and it doesn't usually end well. And I see it every investment cycle. One of the news stations, they'll profile someone who's it's usually someone young or 20s or 30s. They'll profile someone who's been in the market for a short time and have done really well. So I remember this happening during the .com boom. Was the late 90s, and it's one of those 6:30 current affairs shows. They had this mum. It was a mum with a couple of young kids, and she famously said, "I can make $10,000 while making the kids lunch." And I just hate these sort of things when they come on. I saw it recently. It was just on ABC 3 months ago. They profiled a 21-year-old uni student and an NRL player, footy player, and the uni student was up 20%, first-time trader. And the footy player made back his lost salary through the salary cuts during COVID, and this is it's terrific for them. They've done well, and all the power to them. But you just wonder about what process led to those outcomes, and are they repeatable? And this is the thing. It's got to be repeatable success. Otherwise, it's a trip down to Crown, and you played roulette. Because I know if I stand in front of those casino doors for long enough, I'm going to meet. Someone's going to come out and tell me I've had my first day at the roulette table and I've won some money. So it does happen, but you can be pretty sure they're going to go back next week or the week after, and it might not be the same, because you can't systemize games of chance. You want to take as much chance out of it and make it more repeatable. And this is what I learned in the charting department. So I was just so lucky. Had one of the best chartists in the business to work with, and he taught me that markets move in 3 phases. You've got the up phase, the down phase, and the sideways phase. And if you can identify what phase you're in, well, then you open up the potential to make a lot of money. And another good thing about being in the charting department was that the heads of all the various trading desks would all come in to talk to him at various stages. And I remember this one conversation, the head of the algorithmic trading desk. So this was a fairly new thing back in the 90s, early 90s.
Would have been very yeah.
And this guy, he was the superstar in a room of stars. And he came in like he was like this one guy was sort of like the jewel on the Bankers Trust dealing room crown at one point. And so he came in and he's talking to my boss, and he said that he could statistically prove that markets move in trends. And that just fascinated me because, like, I'd just come from uni where the professor had been saying that there's no markets are efficient, and as soon as news comes out that it's factored into the price, so there are no trends and there's no advantage you can't beat the market. And then I've got this superstar telling me that you kind of can, because markets move in trends, and trends give you an edge if you know how to identify them, whereas a roulette player doesn't have an edge. The casino's got the edge. So it's all about playing games with the edges with you, not someone else. And so this guy ended up being poached by a hedge fund in Bermuda. And so he left the leading investment bank in the country, where he would have been paid well over $1 million a year. This is back in the early 90s. I'm guessing it's salaries, but that was sort of like the word.
Yep.
I think within a couple of years in Bermuda, I've forgotten the numbers now, but it was like they were paying him 10 or 20 or 30 or $40 million. And this is all through applying a technical, process-driven approach to markets. So he wasn't trading individual stocks, he was trading futures markets, so currencies, bonds, commodities, and using the principles which I use now and many people do. And and that all started from my luck of landing in the charting department rather than the futures floor, which probably wouldn't have been talking today had I gone that way.
Yeah, there you go. So walk us through from there. So you sort of started to grow up in the charting area. Where did it go to from there, mate?
It was about 10 months in charting, and then I had an offer to join the foreign exchange desk. And so that's where you actually start trading. So in the charting department, you're learning and you're providing information to the traders. Get yourself on a trading desk, and you start using the bank's capital to hopefully make the bank money. And the way it goes is that if you make the bank money, they pay you well. If you don't make the money, they tell you to go somewhere else. And it's an investment bank dealing room. It's a fascinating place, but it's a cutthroat place too. It's probably one of the most unsecure of jobs you can get. And this is why I never really bought property during the 1990s, is because I had a high paying job that I was never sure was going to be there in 2 years' time. So it's a funny world, and but it was a world where I got an unbelievable education in how markets work, and which is fortunate in itself, because I know most people learn through reading a book. They don't have access to the sort of mentors that I had. And reading a book is powerful. It's really good, but nothing quite beats sitting next to somebody who's had the experiences themselves and can mentor you and teach you. They can say, "Look, this is what's worked for me. This is what hasn't worked," and it gives you the ability to build your own framework on their scaffolding.
Yeah, I love
it. So BT was brilliant for that. And so look, I was there for for 9 years, bookended by the 90s, 1991 to 1999.
There you go. Yeah, something I wouldn't mind delving into just right there, because and it may have changed now, but back in those heady days, when you're either making money or you're out the door, there must have been a lot of pressure to take trades, just to be seen to be taking trades versus. I'm sure we'll talk about this later on, but there are times when it's better not to take a trade.
That is such a perceptive question. It's because I don't think anyone ever sort of come up with that before. People just seem to assume that traders are there constantly buying and selling, and it's a hive of activity, and it's just how it is. But you're so true. It's There was an underlying sort of, as a trader at an investment bank, there's an underlying expectation that you're going to make something happen. And there are times in the market when there's nothing happening and markets are moving sideways. They're just choppy and they're hard to make anything from. And it's that expectation to make something happen, which often causes a trader to go out and take a trade when they really shouldn't. They really should just sit there and do nothing. And this is the advantage that the everyday trader has over the professionals, because the everyday trader can choose to do nothing. Whereas if you're sitting in a hedge fund or a bank, they're paying you a big salary to do stuff. And it's short-termism in a way. But when you're doing your own thing, you can be a lot more selective. Yeah. And if you decide you don't want to play for 6 months, well, that's just fine. If you don't see the setups and the opportunities, you walk away and you do something else for a while until the right opportunities are there. And it's only then that you step forward, because it's all about having an edge. Unless you've got an edge, you're going to be giving money to those that do. And trading when the conditions don't suit, there's no edge there. That's just, I might make something, I might lose something. It's activity for the sake of activity, which is rarely a good thing.
Yeah, I mean, we've all heard the Warren Buffettisms, but one of his famous quotes is around, or a story about him is that he's like a batter playing baseball, and he only hits the perfect balls. He lets most of the balls go through to the keeper, and he just waits for the perfect ball and then hits it for a home run.
Yeah, that's it. There's this great quote by a guy called Jim Rogers. He's a famous hedge fund guy. He's very, very notable during the 90s. I think he actually partnered with George Soros for a while, and he said, "I just wait until the money's sitting in the corner, and then I go over and pick it up." And that's just magic. That's what people should do. But the need to do something, the money burning the hole in the pocket, it just causes people to do stuff which they really shouldn't. Just wait until you get the right opportunity and then hit it, rather than sort of like trying to jump ahead and do something that's not there to be done.
Yeah, that's where that patience muscle really needs to be very well developed, and patience is something that very few of us have in this day and age with the instant iPhone everything that we're currently dealing with. So, and I know we'll get to this, but that's where the technical trading that you bring in with the rules and the system eliminates a fair bit of that. So you're only going in and going out based on predefined measures, so that your emotion and your personality is pretty much kept out of it.
That's right. It's there's a whole lot to that. It is about keeping the emotion out of it and knowing your personality. And so listen to some of these quotes, the Buffett quotes and the Jim Rogers quotes, and there's a lot of glib comments and quotes which just rubbish, but then there's a lot of really good stuff too, which like Olin Grain, and I'll remember like Jim's quote I read when I was 23. It's in a book called Market Wizards. And I've remembered it. All these years, 27 years later, I'm still quoting it. It's because it's so good, and people sort of like can can grasp onto some of those key concepts that can come through a memorable quote, it can really help them moving forward.
Totally, and we'll come back to some of those shortly. But okay, so clearly got to a stage where doing well, because if you lasted 9 years with BT, mate, you must have been doing well. There's no second guesses there.
When the head of the dealing room gave me my graduate job, he said, "Jason, welcome to this side of the revolving door." That's what they used to call it, the revolving door, because there's a lot of activity around that door. They'd be coming in, they'd be going out because they hadn't made money, it hadn't worked out, and it could be quite a quick turnaround. So a 9-year tenure was pretty good.
So how did that come to an end, mate? What did you decide to leave? Tell us about that story.
No, I was asked to leave, actually. It's one of the worst times of my life. It would have been. It was wasn't asked to leave. I did anything wrong. It was a redundancy. You see. Bankers Trust
So you're doing too well, mate. You're costing them too much money. They've got to get rid of you.
No, they only pay you a percentage, so you can they can never pay you too much because you're always making them a whole lot more. But so you see, Bankers Trust Australia was going great guns. Problem was the head operation was in New York, Bankers Trust Corporation, and there was an emerging markets debt crisis in the late 90s, and BT New York had big positions around the wrong way. They lost a lot of money. The balance sheet for the bank was damaged, and management decided that the best way to rectify the situation was to find a buyer, and they found Deutsche Bank, and Deutsche Bank took over Bankers Trust in 1999, and so Deutsche had an operation in Sydney. They didn't want the Australian operation, so they funds management got sold to one business and exists today as the brand name BT.
Yeah. And
the dealing room went off, the investment banking side went off to Macquarie Bank. And what I did didn't suit the Macquarie model, so myself and many of the other traders were made redundant. And I thought this was the absolute end of the world. It's like my whole identity was tied up in being a senior trader at a leading investment bank, and in the space of a few months, it was all over. And I got on a plane, went up to Hong Kong, went to Singapore, and I was looking for other trading jobs. But it was one of those lulls in the market where banks were putting people off; they weren't putting them on, so there's nothing going. And it's So, look, I just thought it was disastrous. But when I look back now, it was actually a golden opportunity, because it was the nudge I needed to go out on my own. And I haven't looked back since. And the thing is, had that not happened, I wouldn't have gone out on my own. I would have stayed at BT because I had a good position. I was being paid great money with the blue sky potential to increase that. Those earnings through making the bank more money, so I wasn't going to go anywhere. But it's worked out. Well, I'll never know how it would have worked out had it not happened and I'd stayed there. But I wouldn't swap what I'm doing now for what may have been had I continued at BT. That's what I'd say to people. I'd say, look, tough times pass, and it can lead to some really positive outcomes. And it's just so amazing how resourceful you get when you put in a situation like I was, and you think it's the end of the world, and you work out that it's not. And look, that led to a really creative period of my career, a new business, and it's led me to the whole winding track. But it's it's just amazing how new opportunities always present themselves. And something that seems like it's a big setback or it's a failure of some type. It's at the moment it may feel that way, but how things work out in the future, it's often you can't understand it at the time, but you get to new places which are really good.
Yeah, I absolutely agree. Talk to us about because it would have been like falling off the cliff. Not only is your effectively your profession's gone to some degree, but your income would have fallen off a cliff as well, which would have been pretty scary financially, I would imagine.
Yeah.
What were you thinking and feeling, and where did that the next step, as I understand it, was to start Fat Profits. But I'd love to know the thinking process that took you through. Why you decided to do that, and where did it go from there?
Yeah, it was it was a real upheaval. So I had at the time during the 90s, I lived the young investment banker life and had the Harbourside apartment in Sydney, and had the great lifestyle of going on trips and having fun, and then I found I left. I'd been there for a while, so I got a good payout. But then that doesn't set you up forevermore. You had to do something else. So to conserve cash flow, ended up my girlfriend and I, we moved to her brother's garage. So I've gone from Harbourside to the suburban garage. Now, might add, it was a nice garage. It'd been renovated. It was more of a granny flat sort of thing, but we call it the garage. And so we were must have been there for about a year. Whilst I was just trying to figure out, what am I going to do? There's no jobs for what I do. I don't want to change careers. I don't want to retrain. This is what I do. I love the financial markets. And I was talking to an old colleague from BT, and he said, that René Rivkin, the Rivkin report? And I said, yeah. He said, well, I reckon we could do something like that, but do it better. I said, yeah. What are you thinking? He said, well, look, I know a balance sheet and how to analyse a company, and all the price analysis through looking at price movements. And so I reckon if we can put those together, we can come up with a really, really good product that we could sell. And I thought, yeah, I reckon that's a pretty good idea. And so it's an example of being creative with your skills. So rather than using my trading skills to make money for the bank, I was using those skills to create a service which helped everyday people make money from the stock market. And so that's how my first business was formed. We called it Fat Profits. Profits spelled PROPHETS. It's just a quirky branding thing.
I love it.
Getting the play on profit, and so that's what I did for the next 7 years. We built that up. So it started off just the two of us it was a 28 square metre office in Australia Square, because that's where Bankers Trust used to be based. So I was back to where I kind of started my career 10 years earlier in Australia Square. And so I've got this little pizza-shaped office. And by the end of it, when I left, and when I sold my share of the business in 2007, and we had about a team of about 30 people. So we're in quite a good-sized operation. And, that's the thing with adversity. You just never know, and you get creative. And that's what we did.
Why the change? I mean, again, 30 people's a big team to feed, and you'd start becoming a manager rather than a doer, and therefore I can imagine some of the joy out of what you're doing probably started to dissipate because you're more a HR person and a counsellor than you are a doer in the markets. It's a fair time to invest to say, right, well, I'm out of here. Tell us about how that came about and how that led you to the next step.
Yeah, you know the routine well, Bushy. It's that's exactly what happened. Doing what you want to do, which is analysing markets, to trying to analyse markets whilst managing a business. And that was challenging, and it wasn't the doing all the HR stuff. It wasn't, we got people in who did a lot of that stuff, but still it's still classed as a small business. There's a lot of stuff you got to be across. But look, in the end, it's like, it was a partnership, and partnerships are really good when you start something and you bring in two different sort of perspectives, which can make 1 + 1 can equal 3 in a good partnership. But then after a while, people's interests start to diverge, and there's a natural time in every partnership to say, look, we've run a really good race, and now's the time to probably go and run our lead the relay and do the individual runs. And so that was the right timing. It was probably 7 years into Fab Profits. And look, it's chapters. Life's a big book with lots of different chapters. So, your childhood's one, then you go to your university is your chapter, and VT was a chapter, Fab Profits was a chapter that just led into the next one.
So talk to us about that. So you're sick of having to feed everyone else without and getting you further away from your love of trading. Was that what drove your move into quant trader?
Yeah, look, that'll like the algorithmic side had always sort of like been in mind, but it wasn't a side which I'd actively pursued because I'd been more of a look at just a visual trader. I'd look at charts and I'd look for patterns. I'd be very processed in what I was doing, but it would be visual. And after Fab Profits, like that's when I left the city. So I've been based from home since 2007, and the timing of that was fabulous because it meant like we had young kids at that stage. So I was able to sort of like then get away from managing a business and have time with young kids, and also have a lot more time to study the market and work out what was the next way to progress in my trading and investing career. And I thought, okay, now's the time to make the shift to algorithmic. So I describe that pretty much as an evolutionary step. So when you're doing something by eye, there's only so many markets or stocks that you can really be across and analyze. When you take things to an algorithmic level, you open up your world of possibility exponentially. And I went from being able to like keep a handle on maybe the ASX 200 to being able to cover the entire ASX. So I've gone from 200 stocks to 2,000 or more stocks. And so that gives so many more opportunities. And the algorithmic side also, it adds in a layer of consistency, which it's not really possible for someone doing it without the help of an algorithm. As much as you try, as much as you might be processed and systemized in your thinking, there's still going to be inconsistencies with where you enter, where you exit, how you calculate things, the emotion of like a powerful move either up or down in the market. If you're not algorithmic, it can still mess with you. You can freeze under pressure or exit something you should have really held. But once you've got an algorithm there and you're calculated levels, well, everything becomes quite clear cut. As long as you can follow a set of rules and a set of signals, well, you can. It really does strip the emotion out of it. So that's what I did after Fab Profits. I sort of moved completely in that direction. Yeah,
for those listeners who are perhaps not familiar with algorithmic trading, we might just break it down very quickly there, so that they're clear on exactly what that means. Can you give us the Dumb and Dumber's guide, so that people understand where that fits into the equation? Yeah. Look. It sounds a lot more complicated than it actually is. So a set of algorithms it's essentially a list of instructions for a computer, and if an investor can clearly define their approach, what they're doing, then that can be transformed into computer language or algorithms. And so that's really, really all it is. And one of the great things, if you have a list of algorithmic rules in a computerized system, is that you can get a whole lot of historical data, and then you can start testing your ideas rather than like a lot of people will, they'll read a book and they'll go, oh, that sounds like a good idea. I wonder whether that'd be a good idea for me to do that. So they go and do it for a while and make money and lose money, see what happens. But once you can take those ideas from your head and put them into code, you can then test them over many decades and see, look, do they actually work? Have they worked in the past? Because if they've worked in the past, there's a
a good probability that they'll work in the future. Whereas if you can see, like over the last 20 years, had I been doing that, I wouldn't have made much money. I would have either plodded along or would have lost money, or just wouldn't have worked out. You save yourself a whole lot of time and a whole lot of trial and error, because you can you back test. That's all part of the robustness of finding a good trading approach.
Yeah, I guess one of the questions I have there around that, and I'm right on side with you. When I was actively trading, when I first started investing, I back tested systems until I came up with something that worked, and I actually had a system then that was 60% losers, but the 40% winners were enough to still produce a profitable system. And
that's such a funny thing, because a lot of people would instantly hear that and go, "Oh, that system's no good. 60% losers," and they instantly dismiss it because they don't understand. This is why trading and investing is just so unintuitive to most people. So most people would look at a win rate and think that unless there's a high success rate, it mustn't be very good. Because like if you're a doctor or you're an accountant or you're a pilot, it's all about high success rates. Like no one's going to get in a plane with a pilot who has a 40% success rate at landing. It's just madness. So that's how we're wired to think. But then you come to this trading and investing world, and all of a sudden people are telling you, "Oh, look, it's okay to only be right 40% of the time." And it's like what? And George Soros, the famous hedge fund guy, he once said that it doesn't matter whether I'm right or wrong. All that matters is how much I make when I'm right versus how much I lose when I'm wrong. And that's it. That's what it's all about. You've got to understand this. Unless you understand that, you're going in with the wrong mindset, and you're probably destined to hit the rocks, because you're going to be thinking, well, none of this is working, but actually might be, but you don't understand the process. So it's interesting you say that, Bushy, that you had that system with the 60-40 breakdown.
Yeah, and it was profitable. And the hardest thing for me at that stage, and I knew myself, because I'm a person who overthinks things. And that's very dangerous when you get into that ground, because you then start to wanting to try to make things happen. And I learnt some expensive lessons there early around that, and hence I gravitated towards technical trading, because it removed that. If I had a set of rules that I knew worked through history, and then that meant that there was very definite triggers to get in and very definite triggers to get out, and I knew that I just pulled the trigger when that occurred, then I'd remove myself from the process to a fair degree. But something I wouldn't mind digging into just there, because particularly given recent years where there's so much dynamic change in what's happening in the market, and now a lot of the electronic trading, so that it's happening almost by remote control, can start to drive volatility. How does that factor into your rules around the algorithms? Because the dynamics of trading is changing to some degree, or it would appear to. Does that influence the algorithms, or does that mean that you sort of periodically review the algorithms to make sure that it's still working in the confines of how the market's actually behaving?
It doesn't have a great effect on what I do. So I'm focusing more on medium term. So for me, medium term is I'm looking for stocks with the potential to significantly increase their price over the next maybe 1 to 2 years. And the sort of volatility that comes through things like high frequency trading, it's a particular type of hedge fund that uses algorithms, turning over stocks within seconds.
Yeah.
And that's a very different end of the time frame spectrum. So the noise that a lot of the short term stuff happens, it doesn't really have that much of a effect out with the medium to longer term strategies.
Perfect.
It's it's like a tsunami's ripple out in the ocean. You barely notice it, but it gets into shore. It's causing havoc. So if you're a short term trader, there's there can be like quite a lot of activity in the intraday during the day, but if you're out medium term, you don't know what's going on. It's sort of like passes below you, and it's not such a big deal.
Yeah, perfect. Sorry, Matt, I took you on a tangent there. So you're developing quant trading, and you're effectively doing that by yourself and for others at that stage. Is that how you had the business model for that?
Sorry, what was that? By myself and
so you're developing quant trader at this point in time, which is driven around the algorithmic investing style.
Right, quant trader. Yes. So So there was so what I did was so I was doing my own trading. This is before Quant Trader came along. Quant Trader is a service which I started providing in 2014.
Right.
So, but after I left Fat Profits in 2007, that's when I started to work towards my algorithmic trading for myself, not to offer a service.
Got it.
And so I developed. I spent a year developing an algorithmic system for the futures markets, and then I traded that with my own account over the next 4 or 5 years, and it was only some time later that one of our analysts from Fat Profit then started working with the business that I did Quant Trader with, said, look, we'd like to create a trading service for everyday traders. Would you be interested in trying to create something? And that's where I thought, look, I could transfer the algorithms I'm using for futures markets and adapt them to equity markets, because the principles are the same. A market is a market. Up phase, sideways phase, down phase, same thing.
Yep.
And so it was just tweaking it to fit share prices rather than leveraged futures, and that was how I got involved with providing a subscription-based service for people to sort of get involved with this algorithmic investing style that I've been using for myself for quite a while.
Okay, yeah, awesome. And that has that sort of evolved into Motion Trader, or what was the change between Quant and Motion?
That was due to Quant was someone else's business, which I provided a service for.
Right.
And I'm always telling my kids, look, you got to get out there and look. Have a real go, take opportunities and push hard. And what I was doing, I was working with another business, and it was time to sort of like say, look, okay, it's time to go out on my own and do my own thing again. And so rather than producing Quant Trader for a business, it was running the Motion Trader business, which is completely my own business. So I'm back to where I started really with Fat Profits, with my own subscription-based business.
Well, freedom fighters, how good was that? To get a summary of all this investment gold in the show notes, just email me on hello@khgroup.com.au. That's hello@khgroup.com.au. Or check us out at www.bushymartin.com.au/get invested. I look forward to joining you next week for another episode of the Get Invested podcast. So thanks for listening, and as always, dream as if you'll live forever and live as if you'll die